Welcome to the Retirement DNA podcast. I'm Aaron Johnson, and we believe that you deserve financial advice based on your best interest. In our podcast, we discuss all aspects of retirement planning. And today I want to talk about why you should separate income and growth in your account or your portfolio, okay? So this year, and probably coming into this next year, there's a lot of talk around volatility, right? And what is volatility? Well, it's just a fancy way to say risk, right? Volatility is risk. There are good risks and bad risks. The good risk so far with the market is if the market shoots up and you make a lot of money, that's a risk that you're willing to take because your money has gone up. You're willing to risk that it goes down during those good times that you're making money. But it's the risk of your money going down that no one likes, right? So we like it on the upside, but we don't like it on the downside. And when the market goes up, that risk of that account that's going up, that one has never hurt anyone, has it? Right? It's the bad risk that makes your accounts decline and go down and that everyone worries about. So we're going to talk a little bit about that today. And I want to start off, I just recently came across a JP Morgan Private Wealth Management white paper that is out there. This was written August 16th of 2022, so this year. And it really talks about that. And if you want to go look it up, it's you can Google JP Morgan Private Client Group. The title of the article is Retirement Planning, ? Even multimillionaires can run out of money. And I'm gonna read some of this to you, and then we're gonna kind of talk a little bit about it, and then look at why do they say this, and then also how can we change things so that there's not a chance of you running out of money. So here's what it says. It says, once upon a time, not long ago in the United States, the 4% rule was a reasonable rule of thumb for everyone, including the wealthy, when planning their retirements. You could expect to spend around 4% of your assets annually and would be unlikely to run out of money during the rest of your years. No longer. The financial planner who devised the 4% rule has declared it invalid due to the lower returns and higher inflation all economists now see on the horizon, and which we agree. We agree with JP Morgan and the advisor on that. JP Morgan then goes on to say that they agree it's time to toss the 4% rule out the window, as spending that much every year might now lead to anyone, yes, even those with multi-million dollars, to outspend their resources. Now, if you look at other articles dating back to 2013, Morningstar, right, that analysts and that website at Morningstar, they've said this 4% rule isn't going to work in the future, and they've been saying that for the last 10 years. So JP Morgan's starting to catch up now. So this obviously leads to the question of, as they go on to say, it says, this means burning question remains. How much might we safely take and spend in our retirement? And their analysts now suggest the likely number is between 2 and 3%. So I'm going to skip down here to their probabilities that they see. Now they're looking at a 30 million taxable portfolio. So not even IRAs or 401ks. They're talking about 30 million in a taxable portfolio. And my guess is that many of you that are listening to this are going to fall under that $30 million mark, right? If you've got over that, my guess is we need to talk about some legacy planning, depending on what you're needing for income, Now, here's what they say is they have a annual spending rate and then different portfolio mixes and their probabilities of running out of money and that plan failing. And their spending rate goes 4%, 3%, 2%. So if you're in 100% fixed income in bonds, you can take 4% out and you will fail 100% of the time. A conservative allocation, and they don't tell us what a conservative allocation is, at a 4% withdrawal rate will fail 93% of the time. And they're saying a balanced portfolio will fail 78% of the time. If you are in a growth portfolio, that will fail 69% of the time. If you're looking at a 3% withdrawal rate, fixed income fails 61%, conservative allocation fails 29%, a balanced portfolio fails 29%, a growth portfolio fails 32%. And they're even saying that with a 2% withdrawal rate, now this is off of 30 million, remember, so $600,000, a balanced portfolio will still fail 3% of the time. So tell me, why would you not just go to the bank and get a 3% CD, and now we know it's not going to fail, right? Or why would you not just do a fixed indexed annuity that's going to average between 4 and 7 and no loss to your principal, right? So this is what this really gets at is these withdrawal rates. And I want you to think about, why does JP Morgan give us a conservative, balance, and growth portfolios when they're not offering any other strategies? And I want you to think about this. And why do a lot of financial firms tell you that now you can no longer get 4%? You can no longer take out 4%. Well, I can tell you that part of it for JP Morgan is, let's say you take 3% of your portfolio. Where does the other 97% stay? Right, with JP Morgan. They're going to be able to collect those management fees off of that. So I say all of that. They don't offer any sort of solutions or say that there are any other options other than, hey, you're just going to have to take out less. So what I want to talk about today is how to structure your accounts so that you are protected, so that your income is protected, so that we can still have growth, but we don't have to worry about those negative years, right? And a lot of times people talk about a growth and income portfolio, and that's really all you might need. Well, we would say you need to separate those two, okay? So the bottom line here is that when you're retired or you're nearing retirement and you've been working 30 to 40 years, you aren't happy if you have to be worrying about your money that you've saved for 40 years. And is that money going to last for the next 20, 30 years, right? That sort of worrying destroys the point of retiring, right? So there are people out there who have retired and they wake up in the morning and they think about what would make them happy. And it's typically things like spending time with the grandkids, traveling, going on vacations, spending time with family. They don't want to have to worry about what the markets are doing and wondering if they can afford to take the cruise or not. And by the way, we've seen several clients this last year that they're paranoid about how the market has destroyed their savings and their retirement savings at other places. So we want to talk about how we can set up your portfolio correctly, and we'll do that in just a minute, right? But if you're worrying about that, those are some signals that you maybe need to restructure things, right? So maybe you need to give us a phone call. We can give you a second opinion and make sure that you're on track to meet your secure retirement and get things structured properly. So how do you set up your accounts? Well, I can tell you the biggest mistake people make is when they retire, they continue to hold the balanced, diversified allocation and just reallocate and rebalance once a year, and they take their 4% withdrawals. And this is what almost every major firm, Wall Street firm, recommends, right? And this is what was done back in the 90s and early 2000s. When I got my start in 2003, I can remember being taught and told that, hey, everyone just needs a balanced portfolio. They can take out 4% and they're going to be fine. Well, guess what? As the saying goes, pride comes before the fall, right? Pride goes before the fall. So in 1999, and then again in 2000, and 2001 and 2002, we basically had years, those years, the market just went down, down, down. Well, everyone that was taking out their 4% withdrawal, by the end of that third year, or even fourth year, their portfolio was down 50%. Why was it down that much? Well, they were down 12% just from the withdrawals that they had taken out, and then the market went down even further, right? So if you've taken out 12%, you don't have to make 12% to get back to even. You've got to make more than that. And with the markets going down, that hurt even more, right? So what everyone learned, though, was that if you were young and you had time, this 60-40 portfolio, you could ride the market up and down because you had time to recover. But if you were retired or close to retirement, you got crushed, right? It only works when markets are going up. And any solution that only works when markets are going up and not when markets are going down is a terrible thing and shouldn't be done. And based on recent research, balanced portfolios don't work 70% of the time that there is a year with a 20% decline or more. Guess what? That happens all the time, right? It happens all the time. So we have to count on the fact that there's going to be a 20% decline. So how do we fix it? Well, we basically take your portfolio and we separate it into two different components. One component is protected and is going to be a safe place to generate income. But you can't just put it in cash because it's not really doing much, right? Rates are getting a little bit better, but they're not wonderful. And you can't really put it in bonds these days, right? Or your money's going to go down. You have to put it somewhere where it's protected, where it's insured, and it can actually get a decent rate of return. In our world, by the way, you should probably be using like a fixed indexed annuity or something similar to that. But you can't just use any company out there. There's hundreds of companies that do fixed index annuities, and probably only about a handful of them are worth investing in. So that's your protected part, your income part. You can't lose money from it. And we can safely generate returns and your income. The other portion of your portfolio is what you put in the market, right? So we want to protect the income piece, that protected part, that first component. And that way we know that your income is going to last 12 to 15 years. And that means your growth part, your growth portfolio that's in the market now has 12 to 15 years to grow and ride the market's ups and downs. And if you set it up this way and you're close to retirement or you're in retirement, you know that when you retire, you will have the income that you need, and it will be safe, and it will give you a decent rate of return. And we also know that you're not going to have to worry about income for the next 12 to 15 years. It does not matter what the market's doing. Now, in that growth bucket, that we have, we don't just put a balanced portfolio in there and let it go. We don't just throw it into stocks. No, we want it actively managed so that the portfolio changes as the economy changes. It needs to be able to move to cash as markets are declining and we go into recessions. It needs to change and rotate different sectors. It needs to be able to look at our growth stocks better or our value stocks better, right? We can have dividend pieces in there to help generate a little bit more as markets decline. So what about if you're already retired, right? It's not too late and we can fix it, but you can't sit there and say, well, I'm going to wait for markets to return and get back up to normal, because we don't know when that's going to take place. If we're heading toward a recession, markets are going to go down further, right? Maybe you need to sit in cash for a bit and move part of that piece to that protected income so that we can start generating that income. And as markets go back up, it will also go back up. But we need to take action now. We can't just wait, right? So our goal at the Dwayne Johnson Group and Bridger Financial Services is to make sure that our clients know that they can make it to and through retirement and can spend with confidence during those years. We want to make sure that you have financial security in any economy. So thank you for listening to the Retirement DNA podcast today. If you have any questions or you'd like to sit down with us for an initial consultation, second opinion, or to see if you're on track to meet your secure retirement, give us a phone call, 951-244-6702. If you like what you've heard, please subscribe to the podcast. Check out our YouTube page, Dwayne Johnson Group, where we do educational videos and market updates. Please tell your friends and family if you think that they could benefit from the information as well. You're also welcome to check us out online at DwayneJohnsonGroup.com or BridgerFinancialServices.com. Again, our phone number, 951-244-6702. Thank you and have a great day.
Investment advisory services offered through Bridger Financial Services, LLC, a registered investment advisor in the state of California. Insurance products and services are offered through Dwayne Johnson Group, LLC, affiliated company. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Dwayne Johnson Group, LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Dwayne Johnson Group, LLC.